Many accounting students struggle with journal entries, T accounts, and balance sheets, all because they don't fully understand one simple system: double entry accounting. It's the core of everything in accounting, yet most students either skip it or memorize it without truly understanding how it works. But in this video, I'll explain double entry accounting in the easiest way possible, and you will finally understand how it works. Let's begin. So, what is double entry accounting? Double entry accounting is a system used to record every business transaction. But here is the key part. Every transaction is recorded in two accounts. One side shows what the business gave and the other side shows what the business received. Because in real life, when something comes in, something else always goes out. Money doesn't appear or disappear on its own. That's why every transaction has two sides, and this keeps your books balanced. For example, let's say you buy a laptop for your business and pay $600 in cash. You now have a new laptop, but you also spend $600 in cash. So here, two things changed. Your cash went down and your equipment went up. Both sides of your records are updated, and that's double entry in action. This method is used all over the world by businesses, accountants, and banks because it's clear, accurate, and helps prevent errors. And it all connects back to the most important rule in accounting: assets equal to liabilities plus equity. Every transaction must keep this equation in balance, and double entry accounting makes sure it does. So why is double entry accounting so important? Because it helps you keep accurate records and it makes sure your numbers always balance. With double entry, every time money moves, you can clearly see where it came from and where it went. This helps you track your business, find mistakes, and make better decisions. It also connects directly to your financial reports like the balance sheet and income statement. Now let's talk about two keywords you'll hear a lot: debit and credit. Don't let these terms confuse you. In double entry accounting, a debit means values coming into the business and a credit means values going out of the business. But here is a common mistake. Many people think debit always means increase and credit always means decrease. But that's not true. It actually depends on the type of account. For example, debit increases assets but it decreases liabilities, and credit increases income but decreases expenses. So the meaning of debit and credit changes depending on which account you are working with. That's why it's important to learn them in context, not just memorizing definitions. Think of it like this. If you receive cash, that's a debit to your cash account, and if you spend cash, that's a credit to your cash account. Let's make it even simpler with an example. You pay $200 for office rent, so you credit cash because money is going out, and you debit rent expense because that's why you are paying for. You record it in two accounts. That's double entry in action again. And yes, every transaction in accounting works this way. Once you understand this, journal entries, T accounts, and financial statements will be much easier to understand. Now let's talk about the 5 main types of accounts in accounting. These are the building blocks of all financial records, and understanding them is key to mastering double entry accounting. They are assets, liabilities, equity, revenue, and expenses. Assets are things the business owns or controls that has value. They help businesses run or earn money. Some examples of assets are cash, inventory, equipment, land, account receivable, and etc. Liabilities are things the business owes to others. For example, bank loans, account payable, tax owed, and etc. Equity is the owner's share of the business, and it shows how much the business worth to the owner after all debts are paid. Some examples are owner's capital and retained earnings. Revenue or income is the money the business earns from selling products or services. Some examples of revenue are sales revenue, service income, and rent income if the business rents out property. Expenses are the costs a business has to pay to run or operate. Expenses include rent, utilities, advertising, salaries, supplies, and etc. These 5 account types help us organize every business transaction, and they tell us which accounts to debit or credit using the double entry system. Now that we know the 5 main types of accounts, let's talk about how debits and credits affect each account. This part is very important because understanding this will help you record any transaction correctly using double entry accounting. First, remember, debits are entries made on the left side and credits are entries made on the right side. But what really matters is what they do to each type of account. So, Let's go through them one by one. First, assets. When you add to an asset, like pouring more cash into your business, you debit it. When you take money out, like buying something using that cash, you credit it. For example, if you receive $500 in cash, that's a debit to cash. If you pay $100 from your bank account, that's a credit to cash. So remember, debits increase assets, credits decrease assets. Now, liabilities. These work the opposite way. When you take a loan or owe someone, that's an increase in liability and you credit it. When you repay part of that loan, you are reducing the liability, so you debit it. For example, let's say you borrow $1,000 from the bank. That's a credit to loan payable. Then you pay back $200. That's a debit to loan payable. In short, debits decrease liabilities and credits increase liabilities. Equity. When the owner adds money into the business, that's an increase in equity and you credit it. But if the business gives money back to the owner, that's a decrease, so you debit it. For example, if the owner invests $2,000, that's a credit to capital. If the business pays them a dividend, that's a debit to drawings or dividends. Equity follows this rule. Debits decrease equity and credits increase equity. Next up, revenue. When the business earns money, you always credit revenue. If for any reason you cancel or reduce revenue, you debit it, though that's rare. For example, if you sell a product for $500, that's a credit to sales revenue. The rule for revenue is simple. Debits reduce revenue and credits increase it. And finally, expenses. Whenever the business spends money on something like rent, salaries, or ads, that's an expense and you always debit it. If you get a refund or reduce the cost, you credit the expense. For example, if you pay $100 for advertising, that's a debit to advertising expense. So, debits increase expenses and credits reduce them. So, here is the big picture. Every time you record a transaction, you are doing two things. One account is debited and one account is credited. Always. That's the heart of double entry accounting. And now, you know exactly how to do it across all 5 types of accounts. Let's now apply everything we have learned with real examples. This is where it all comes together. We will take real-life business transactions and show you which accounts are involved, what gets debited, and what gets credited. Example 1. Let's say the owner puts $2,000 into the business. Now, what's really happening? The business receives cash, which is an asset, and that asset is increasing. At the same time, the owner's equity in the business is increasing too. We debit cash for $2,000 because assets increase with debits, and we credit the owner's capital for $2,000 because equity increases with credits. That's it. The transaction is balanced. One debit, one credit. Example 2 says the business purchases $500 worth of inventory and pays for it in cash. So what's happening here? Inventory, which is an asset, is going up, and cash, which is also an asset, is going down. In this case, we debit inventory for $500 because it's increasing, and we credit cash for $500 because that's decreasing. Again, both sides equal and the book stays balanced. Example 3 says the business sells goods and receives $800 in cash. So, cash goes up, that's an asset increasing, and since the business earned revenue, that goes up too. We debit cash for $800 because assets increase with debits, and we credit sales revenue for $800 because revenue always increases with a credit. Simple and balanced, just like it should be. So if this video helped you understand accounting better, leave a comment and tell me which part finally clicked for you. Give it a like so more students can find it easily, and don't forget to subscribe, because in the next video, we will dive into journal entries and how to write them correctly with tons of clear examples. See you in the next video.